Hello, Sector Watchers. Welcome to the 14th episode of Sector Spotlight on Tuesday, the 7th of January, 2020, that is. This is your weekly update on sector rotation and anything remotely connected to sectors, relative strength, and our rotational analysis. My name is Julius de Kempenaer, and I'm your host for today's show. As usual, Rachel and Zach are with me for production and technology. If you want to participate, the chat box is open during the show, and we will monitor any questions that are coming in. However, email seems to be the preferred way of communications, and that is totally fine. Just don't be shy. Ladies and gentlemen, this is Sector Spotlight. So what are we going to do for today? It's the first show of the month, which means that we're going to look over some monthly charts for asset classes and sectors. I want to bring in some seasonality, working off the stuff that I did over the holiday period. We'll have a break as usual. We'll have at least one question from the mailbag, and then we'll have a new pair trade idea. Let's start with some charts. So that's that. And we'll have the chart here. So the overview of the performance over the last month is quite surprising because we had commodities being the best asset class over the month of September with a 4.2% rise, followed by, it's going to be boring right now, the stock market with a 2.2% rise, and then there was some other stuff. And on the weak side, we see T-bonds and the US dollar predominantly with a -2 and a -3. We look at the sectors, then we have an image that looks like this. The best performance in December was for energy and, again, for technology. A lot of stuff that was in line with the index. This one is relative to the S&P 500. And then the biggest underperformers, staples and industrials with -1.6 and -2.3. We do this on an absolute basis. All sectors were up in the month of December. So it was, again, a very good month for the stock market. As I said, we're going to look at some longer term charts, and we're going to try to tie that in. Let me bring in my chart list for monthly asset classes. And I had that nicely sorted with numbers. Here you go. So if we start, and I'm going to use the unadjusted, the stock market, super strong. Another new high on the monthly bars. There is absolutely nothing wrong with this market. Hopefully we'll get to later on that we're getting a little bit overstretched. You see a lot of articles, you see a lot of shorter term sort of warning signals, I think I should say. But just let's make it very clear that the long-term picture for the stock market is absolutely fine. There's nothing wrong with it. And then we go to Treasury Bonds, and we have the adjusted and the unadjusted. This is the unadjusted version. The trend is really very clearly still up. The unadjusted version, there we see that around 114 on IEF, there is a serious resistance level that's coming off that 2016 high. I am going to watch that closely because on the shorter term pictures, bonds are trending up, well, not trending upward. They're sort of breaking out on the upside. Looks as if we're putting in a low here. If that 114 level breaks, that'll be a very good sign for the bond market. So we will see higher bond prices and lower yields. That's definitely something to keep an eye on. If we do the same for corporate bonds, we'll see that the trend is very much still intact. It's going higher. There's a little bit of a correction sideways pattern here that's been broken to the upside, so that's fine. And if we go to the unadjusted version there, we'll see that that one actually broke out. So this is a positive sign for corporate bonds. And I use these unadjusted chart to mark for support and resistance levels, because these unadjusted prices, that's what's in people's heads. That's where people have been buying and selling. The adjusted price series is what you actually get in your pocket, in your wallet, in your portfolio in terms of return. I think it's important to keep an eye on both, because especially with the stuff that's heavy on dividends and coupons like bonds and real estate stocks, where dividend and coupons are a major part of your return, the support and resistance levels may actually differ quite significantly from what you would see in the adjusted charts. We go to high yield, somewhat similar. The trend here, miraculous, very good, no problem at all. If you look at the unadjusted version, we'll see that we're getting out of this consolidation area. There's still a little bit of overhead resistance, but if we break that, what is it, 89 level, then there is quite a bit of upside potential towards 95. And in terms of high yield bonds, that is a significant move. Real estate, again, a very important one for adjusted versus unadjusted. This is the adjusted version. That is a very nice chart, breakout to the upside, very good, no problem. But if we look at this is the unadjusted chart, so without the dividends, then you see that the area around 95, where we're sort of hovering right now for the last 4 or 5 weeks, that's an overhead level. Again, if that breaks, super strong signal for real estate, but for the time being, it seems to be a little bit pressured because of that overhead resistance there. And then we go to the big surprise of this month, that is commodities, and it's hardly visible on the monthly charts. As you can see, we're still working our way off that test of support that we saw in the second half of last year. But if you look at the shorter term charts, we're sort of breaking out this little downtrend here, and within that broad range that you can see here, and that's now already spanning 4.5 years. 4.5 years. So that's quite a bit of a range. And in that range, there is upside to, let's say, $25 US, which is, again, in percentage terms, quite a bit of a move. And finally, the US dollar. A lot of people are writing about that, and what you can see here is that it's still sideways, but this nice little rhythm, very stable rhythm of higher highs and higher lows that we've seen since mid-2018, that seems to be rolling over right now. So, I mean, all in all, it's still upward, but it's getting more difficult, as it seems, for the dollar to maintain that upside. So it's sort of rolling over here, which could mean some weakness in the near future. So far for asset classes. If we then go to the monthly charts for sectors, I'm going to use the adjusted ones, then we can actually do this really, really quickly, because most of these charts are following SPY, except, that was a good timing, materials. That's one of the sectors that is not at new all-time highs and failed at this high there, at that 2018 high, which makes it one of the weaker sectors. We will see that later on when we start charting it on an RRG. Communication services, nice up move. Energy is one of the other sectors, not at all-time highs, not at all, I have to say. The recent activity made it a little bit more positive, but from a monthly perspective, we're nowhere near getting anywhere of a new uptrend. There is a bit of upside to 65, but there is still a lot of overhead resistance at higher levels from coming off from previous highs. Financials still doing very well, coming out of that consolidation, started to move higher. Industrials, very good on the price chart. Interesting to see how it behaves on the RRG. Technology, this one is almost bending over backwards. I'm not sure how long this is sustainable, but for the time being, we've put in a new monthly high, so a new bar with a new high, new all-time high, and that is just bullish. There's nothing else you can say about that. Consumer staples, solid chart, new high. This is the first few days in January, so the bar before last is the one of December that we need to look at. So that's doing very fine. And then we have real estate, just shy of its all-time high. We saw how it was on the unadjusted chart. It's the same for XLRE, so there's some overhead resistance to work on there. Utilities, very stable uptrend, no problem there. Healthcare, one of the stronger sectors at the moment. What I really like is that it came out of this triangle-like formation that lasted almost all year of 2019, and it's now pushing higher. We may see some sort of a setback in the near future, but I think that these pullbacks, if any, are new buying opportunities to embark on the rally that is underway right now. We have discretionary, strong chart, not as good on the relative as we will see, but you know, in price terms, there is absolutely nothing wrong with this chart. And now we're back to SPY. So what we've seen is that we had a ton of charts that are almost looking like SPY, almost looking like the market. One is going a little bit faster than the other, but they're all in healthy uptrends, broke out of consolidation levels. And we had a few materials and energy, for example, that are not at all-time highs, and they're still working on breaking resistance and need to work their way higher. If we quickly go to the RRG for stocks, where is that? Let's bring in RRG here. I need to bring this one up. So here is the RRG for US sectors. As I said, the three there, healthcare, financials, technology, these are still the strongest sectors in the S&P 500. Let's not go and look at all these. So here is a chart list that I've been working on. I need to bring this to 900. I did that, but apparently I didn't save it. If you apply it to all, then all your charts in your chart list will actually be at 900 pixels. If we look at XLV, I want to pick that one out because I really like this triangle formation that I mentioned on the monthly. It's very well visible on the weekly. We're working our way higher out of that symmetrical triangle. If we see any dips here, that's probably a good new buying opportunity. XLK and XLF, we leave it at that. We see recently some improvement on energy, not surprisingly. On the monthly, it's not all that good. You see that there is some improvement on the weekly chart, but we're running into some overhead resistance levels. What we see here on the relative is that we've been hovering above these lows, which is now becoming some sort of a support level, and the RRG lines are picking up some sort of an improvement. I'd like to see energy to work its way higher, especially take out this 6150 resistance level, and then it can go up the way to 64 and higher, especially if that relative strength continues to improve. It is one of the sectors inside the improving quadrant, traveling at a good RRG heading, which makes it interesting. From a relative point of view, it's still weak, but this could be a little bit of a surprise in coming weeks. Same thing goes for communication services, which you can see has just turned back up from lagging into improving. So if we bring the XLC chart up there, yes, please. All right, that's not working. That's interesting. And the not annotated chart. What is really strong for communication services is the fact that we broke above this massive resistance level that's around 5150. So this is primary. This is the price. This is the trend, which is very strong. This, and I had a nice line drawn here on the annotated chart, is now becoming a major support level, and the RRG lines are picking up. So I am expecting, I am sort of betting that this breakout in price is going to lead the relative strength higher, and it's going to actually cause a rotation of communication services towards and potentially into the leading quadrant. Where you don't want to be, that's also important to note, are from a relative point of view, XLE and XLB. And let me see if I can bring up XLB, if that one is working. That's the one that failed at that high, and it failed massively. That's if this were a candle, that would be a very bearish engulfing pattern. And also the relative strength is absolutely not encouraging and rolling over. So materials is one of the sectors that I would actually not want to hold in my portfolio, because I do think that it's going to underperform further in the coming weeks. Now, XLI industrials is a little bit of a different animal because it actually did break higher above that all-time high, which is good. And it now actually broke the consolidation that we saw in November and December. So that's also good. But I can't not see that yet in the RRG lines or in the relative strength. So it could be a surprise, but I want to see a little bit more confirmation about that, because this trajectory here is not very positive. The only thing, if I put on my pink glasses and try to make a positive story, a good narrative, is that it is very close to the benchmark. So it's moving in line with the benchmark, and this rotation, this tail here could curl up and rotate the other side really, really quickly. I want to leave it at this for the sectors for the time being. We'll go to a very quick break, and I will be back with some seasonality and a question in the mailbag. And we're back. Let me do a quick answer to a question that came in. It actually came in via Dave Keller, who's hosting the final bar here at StockCharts.com. And the question that was asked him, and he forwarded it to me, is with regard to RRG, if a market corrects and then swings back up, how would you use RRG to find good long ideas? Those of you who've listened to the show more often know that I really like rotations that are taking place on one side of the RRG. So in terms, the question is about long positions, so I'm going to shift to the right-hand side. And let's bring up actually with individual stocks. It happens more often, so that's probably a better idea. Let's bring up the Dow RRG here. Of course, there are none here now. Let's do daily. There's more there. What you actually want to look for, so we're talking about a market that was very strong and is now correcting and then snapping back up. So it's already in an uptrend or in a positive move. It's correcting and then starting the second or the third move. And that's what's happening inside the weakening quadrant, and the tail curls back up. That's the pattern that you actually want to look for. So a tail that moves from leading into weakening and then back up. And I think that Goldman Sachs is actually, yeah, this is going really fast. So it's actually good. So what you see here is that, and let's move this a little bit longer. What you see here is that the tail was in leading, it dropped, goes into weakening, and then starts to rotate back. So this is the type of rotation that I would look for if I was looking to get new long positions in a situation where the market is in a correction. This is a buy the dip scenario, basically. So I hope that answers that question enough. And Rachel, you had another question, you said.
Yeah, we do, from Dan. He asks, when using monthly charts, isn't it important to use log scale? Otherwise, the slope can be misleading.
Good point. Yes and no. Well, probably. Let me put it like this. I'm trying to be a little bit pragmatic with that. Log scales can give you a lot of extra information when the moves of the individual stocks or sectors are actually super big. They're so big. Let me get a. If you would do like SPX, and you would take sort of here long-term bar chart, candle in this case, make it 900, and do, I don't know, like whatever, 50 years. I don't know, see what happens here. So now you get so this part of the chart I can still sort of read. It's not too too problematic. Where you want to see like this, that's where it becomes problematic. And that's where I want to, I go to log scale charts when I actually have so much history that my levels are not becoming much clearer. And then you see that this which was like sort of a horizontal level on the non-logarithmic chart, now becomes meaningful. Now you can see where the highs and lows are, and you can find trends, etc. If you don't, so if we look at the last bit of that chart, then that's still pretty good. It doesn't mean anything in terms of percentage moves if you compare it to this. So it's like, I don't know, this is probably a personal preference, I guess. I mean, I can still work with this, especially if I don't make it 50 years, but let's say 15, then it all becomes, a lot more readable. And I don't see any need for a log scale chart with this history and that price move. So the answer to the question is probably do as you please. For me, it is how readable that chart is. And despite the fact that this is readable, I think that if you do it non-log, I get a little bit more white space and stuff on my screen for marking levels and finding trends. And also there's a big debate on whether you can draw straight trend lines on a logarithmic chart. We're not going to start that debate right here, but think about it. If you look at a logarithmic chart and you draw a straight line, you're basically drawing a curved line. And would you draw a curved line on a trend like this? So I don't know. I have no definite answer to that, but these are the things that you need to keep in mind if you work with log versus non-log charts. Anyway, these were two great questions, by the way. I have worked forward a little bit. A lot of people asked for the spreadsheet that I created over the holiday period to visualize seasonality in a different way. This is a spreadsheet that I've been writing about in my blogs and in the DITC. I expanded that with seasonality for asset classes. And there is the chart right here showing the seasonality for various asset classes. It's not as pronounced as sectors. I think that's something that you can expect. But nevertheless, it gives you a couple of nice ideas on how these various asset classes tend to move over time. By the way, this is now made relative to VBINX, which is significantly different than just via the stock market. So the benchmark here is a 60-40 portfolio, 60% stocks, 40% bonds. And this is the outperformance of SPY versus VBINX, which is pretty good, I think. Overall, it's like over 50%. You get really, really enthusiastic in April, where it's 74%. May is pretty good. And then you have September, especially November and December. So I guess the saying like sell in May and go away is put to visualization here, because especially June and to a lesser extent July and August are really weak months for the stock market. If we do that for bonds, then we're actually in a very good period for bonds, and this is a little bit of what I had in my head when I said that IEF was sort of like looks to be putting in a bottom, looks to be going higher over the next couple of weeks. The fact that from a seasonal point of view, half the time it was actually doing pretty well, a lot better than what's coming from March, April, May. And then the month that you actually need to keep an eye on for bonds is August. Well, let's not discuss all of this here. In terms of average return, we see that January is actually a pretty good month for, hang on, I need to switch to this chart here. Filter that and go to January. And this is the average relative return versus VBINX. VBINX itself, so the 60-40 portfolio, on average, gains 0.4% in January. Stock market, surprisingly enough, is minus 0.2%. 2. This is underperformance versus VBINX, mind you. So not that stocks are going down, they're just not going up as fast as VBINX. And it looks to be a very good month for bonds. Now, we talked about the long-term picture. Stocks are really very good. Bonds also good, but not too good. I could think of a short-term trade where you sort of play long bonds, short equities, against longer-term holding periods. But that's just like a little bit of a fantasy game that I'm playing in my head, especially based on this seasonality thing where you can see that SPY isn't doing too well, underperforms VBINX minus 0.2, and IEF is outperforming. So the odds are in favor of bonds outperforming SPY in the coming month. I will continue to do a lot of work on this. One of the other things that I'm going to do is add all the industry groups in similar images, probably sorted by sector. That's a little bit of work, so bear in mind and stay with me for that one. But this will be expanded because I think it's a very cool way of visualizing stuff. And I actually got a ton of positive returns. And if you did not ask for the spreadsheet yet and you would like to have it, just drop me an email at my StockCharts email address and I'll be happy to forward it to you. Let's quickly go back to wrap things up and move to the pair trade idea. And my pair trade idea for this week is actually coming from, I was thinking what to do and where to go, and there are so many ways you can play the market, and we've got so many instruments available nowadays that we can use to put ideas, researched ideas into work and into positions. And the one that I actually wanted to look at here is the growth versus value rotation. And these are the Dow Jones growth indexes and value indexes. Absolutely, you cannot play those. So what I did is actually found IWF, IVW, and then on the other side it's IWD and IVE. These are ETFs representing value and growth stocks, and you can see that they're actually they're at different positions, but the rotations are all the same. So IVW is growth, is the iShares S&P 500 growth. That's the blue one here, and then you got the Russell 1000 growth and the Dow Jones index pretty close together. And then we got the value iShares index sort of displaced. And we've got IWD and value close together. The different positions are caused by the fact that you can use different benchmarks. So if I change that Dow Jones, you will see that they are now sort of shifted to the left. In terms of the idea that I want to present today is being long the growth ETF, so the iShares S&P 500 growth ETF, and short the value ETF. And I picked those because they are very far apart and they just crossed over this 100 level, which makes it a pretty aggressive trade, but I think that's what you need to do when you want to play pair trades. So for this month, this week, the pair trade idea is actually long IVW and short IVE, and I'm going to keep an eye on that. Brings it to the end. This was the 14th episode of Sector Spotlight. Thank you for watching again. Please don't be a stranger and stay in touch. Sector Spotlight airs every Tuesday, 10:30 to 11 a.m. Eastern. Meanwhile, if you want to reach more about sectors and RRGs, please go to the RRG blog on StockCharts.com, or even better, subscribe using the link below each article to make sure you will receive a nudge every time a new article is posted. See you next week.